Yeah, I'll start. So, Mike Kuhn, I wear a lot of hats at Dexible. I write a lot of the code, do a lot of the administrative type of things that, a typical, what you would think of as a CEO kind of does. I do all kinds of stuff.
Okay. Powers, do you want to go next?
Yes, I also, Mike Powers here. I also do all kinds of stuff. Day to day, I do a bit of development and focusing on our infrastructure, making sure things are working as well as they can. I've been in this space since, I guess, a 2017 timeframe. Mike Kuhn got me interested in crypto early on, and before I knew it, I was running nodes in my basement, doing all sorts of crazy stuff. So, day to day, usually pretty much in the weeds, staring at a terminal, keeping busy.
Cool. Mitchell Opatowski here, the official Mitchell, and day to day, I do a few things on marketing and sales right now. I have the co-founder hat, and it just kind of varies what the priority is, but that means a mixture of product marketing and organizing spaces like this. Okay, let's start with the index because I think we're going to have a lot to talk about with Tornado. The basic idea of this index protocol, money token, it's basically the second major yield-bearing token that the Index Co-op has put out. I don't know that much about the history of Index Co-op, if I'm going to be honest, but they've been around for a little bit. I'm assuming it's a DeFi product that got funded at some point early on, has a token of its own. I think it's Index, if I'm not mistaken. This money token is interesting because it reflects some of the ideas that we've had as a team. Strategies are changing in terms of the sophistication that you want and like exposure to the market and how you react to volatility. And one of the things that we've thought about is how do you mitigate risk when you have a liquid position? And that's where this money token comes in. It's basically this, I think it's a token on optimism using perpetual protocol. And the whole idea is you have this USDC position that's taking simultaneous spot long and short perpetual ETH positions. You deposit USDC as collateral. Yeah, and then you open the short ETH perp position. This is the first time that I'm seeing like a delta neutral, a really easy delta neutral token.
Yeah. Well, it is interesting because, we certainly know of, some of the Dexible customers doing a very similar thing where they take a stable coin, use it as collateral because, like, for example, USDC collateral on Maker, there's really no interest payment. It's basically a free collateral position. So they buy ETH and then they short ETH at the same time, and then they play arbitrage across futures contracts on perp. So it's a fascinating strategy because no matter which way the market moves, they're kind of earning. And that is the point. That's really what perp is all about, is to make sure that they try to get the futures contracts to align with spot, and they incentivize the short and long positions accordingly. So yeah, it looks like this money token is just sort of sitting in the middle of this and saying, all right, well, if you own the money token, then you'll benefit from this arbitrage between the perps and the market. What I think is pretty interesting about it is, like you said, Mitch, we've had conversations internally about these strategies, but also looking at the futures market in general. How can we leverage these short-term futures positions to help our traders, particularly when moving across chains. So, something like this is certainly something that could be automated, right? We could certainly automate these positions. There's specifically the compounding that goes on. So that's the other cool thing about it, is as they earn USDC rewards, they essentially claim and compound the rewards back into more money positions.
And you're saying that happens today, or that
yeah,
with this concept?
No, that's what they're saying. This, I think they said weekly.
Oh, yeah, it's weekly auto compounded when the USDC funding balance is positive.
Exactly. Fascinating concept. Remains to be seen if it's stable over time. I mean, one of the things about cash and carry arbitrage is, there has to be, like significant. So theoretically, like a futures contract has to be really expensive relative to the underlying asset price, or, there's really no arbitrage opportunity. So I don't know how much volatility there is on the perp side. In other words, if that protocol is incentivizing the contracts to be as close to spot as possible, then how much arbitrage is really involved? So that's what I mean. Like long term, is it sustainable? Is it real? Hard to say, but it's certainly something to watch.
It's probably one of the more interesting products on Optimism right now. It would make sense why they did it there, because they're trying to reduce the cost of arbitrage. Can't do it on mainnet right now. So they also claimed that the token holders are charged an annual streaming fee of 95 basis points, which is, fairly significant if you have any sizable position, but they claim that there's a projected 10 to 20% APY based on what they call back testing results and current performance. So if you take the delta of those two, you're at least making somewhere between 9 and 19%, I guess, so long as, so 9 to 19% while holding, like your collateral is the stable coin, right? So it seems like a pretty good, easy stable coin position if, you're not in the US, because apparently no US IPs are able to even access the app to buy the token. So just don't be in the US.
Right. Yeah, that's the CFTC controlling future. But again, this 10 to 20%, like that's assuming that perps are inefficient, meaning that they're not closely tracking spot. But I guess if that's an annual percentage, if you look at the daily arbitrage opportunities, maybe they're projecting that there's slight inefficiencies in perp that they're taking advantage of, and that's over the course of a year results in anywhere from 10 to 20%. But even that, like, again, that's saying that the perp contracts are 10 to 20% inefficient across the entire year, and I'd be surprised by that number if that's true. But if I don't know what they're back testing or what they did to make that projection, whether it's hype, whether it's real. But the 95 basis points, that's essentially like a management fee, or I don't know if that's is that a one-time thing? It's an annual. So no, that's weird, because it's not really a performance fee, because that would be based on the profit that the protocol generates. But this is like an annual management fee, 95 basis points.
Yeah, it'd be interesting. Are they paying that on deposit or withdrawal? Because like that would eat into your potential earnings if it's on deposit. But if it's on withdrawal, then the protocol doesn't take their cut until I guess after the results.
Yeah, that's a good point. Like if you move in and out of the position, do you get charged the fee twice?
Yeah.
It certainly implies that, like, if you're a token holder, you get hit with this fee. So if you held it dropped it and hold it again, then yeah, I think they're going to hit you
You know,
multiple times.
an interesting idea might be that I don't think they'll do this, but if for the purpose of the example, they give you the NFT to once you've paid the management fee at some point for a deposit, and then you're able to move out of that position and back in, but you've already signed off that you've paid the management fee for some amount of tokens, gives you a limit or something that you can deposit up to, and that would enable you to get in and out. So like say the market gets shaky for the next 2 months, go into that position, but now the merge is happening, I want to be back exposed to ETH, like I want to see the upside, go back to ETH. I don't know, there's a lot of trade-offs if you don't have that kind of dynamism or ability to shift funds around, just because this stuff still moves really fast. Even if markets go down, and they've been down probably for about maybe 6 months now. I mean, if things start coming back up, then you don't see any of that. You don't really experience it.
Yeah, no, that's I like the idea. Like use the NFT infrastructure to essentially tag the wallet as you've already paid up to a management fee for X amount of money tokens. And as long as you move in and out with an amount below that, whatever the NFT balance or whatever the NFT, assuming it has some kind of properties to it, then one of the properties might be, okay, they paid a management fee up to $100,000 in money. So if you move in and out anything less than 100K, you're golden. You're already paid up for the year. That makes sense. But if they're hitting people with that fee every time they move the token, that's
a little fucked up. Yeah. So I'm not totally sure.
So I mean, it's incentivizing the community to hold. So maybe maybe it's just to control volatility in general with the token. It's possible.
Yeah, those really long-term vaults. Like I think I saw one vault. I don't remember if it was on Yearn or which protocol it was, but there was like a 4-year lockup for tokens, and it just seems absurd. Like that's such a long time. I'm uncertain if I don't think that'll appeal to retail. The only people that sort of concept of a really long lockup, even a year lockup, is a really long time for someone to wrap their heads around. I guess it's we'll see what the demand is like for this, because it could be a good indicator of fund activity and like what their strategies look like right now, how much is still being attributed to market neutral, and then what is the relationship between internal market neutral strategies and looking outside for new types to discover. Like how willing are funds or institutional customers, how willing are they to experiment on their market neutral side, or is that kept close in wraps? I guess we'll find out.
Yeah, and also, like, are they willing to outsource it? Like, how much control do they want over the actual assets that are being hedged and purchased? That we don't really know, but I agree with you, Mitch. I don't know who this is tailored towards. Is it institution? Is it retail? Because I don't know many retail traders that really could probably wrap their head around how this thing works.
Right.
So anyway, but it's an interesting concept. I think certainly warrants watching it to see if it performs as well as they claim.
Yeah. Well, I guess I'll set a reminder for a year from now, and we'll see if people truly made that much. Well, let's go ahead and shift over to Tornado Cash. There was even some updates from yesterday those pull requests on each of those protocols had started cooperating with that OFAC ban. But maybe we'll just go through the top and then we'll give our thoughts, give more to the story. Okay, so August 8th, which I guess was 6 days ago. That happened on Monday. So that was the day that the Treasury put out a press release that OFAC had sanctioned Tornado Cash. In that press release, they claimed that $7 billion worth of what they call virtual currency had been transacted in some form of like interaction that constituted money laundering, which is a half-truth because two different sources had a different story for this. So I think it was Elliptic claimed that 20% of Tornado Cash funds could have been illicit. Another source claimed that at least $1 billion was just stolen funds. So somewhere between $1 billion and whatever 20% of 7 is, I don't know, is what the illicit amount of money really was. And then all of the money outside of that was done by people who weren't trading illicit funds or stolen money from contract exploits. So a little bit of a half truth there. The press release also announced plans to go after any other mixers that launder virtual currency for criminals. So maybe we'll start there, and we can talk about what this means as far as a precedent, like what the next moves might be.
Well, I was going to say, like, just based on your numbers, even if 20% is the number of criminal activity, both Powers and I come from, sort of that government world where we were contractors. And there's always this sense of overreach. Like the policies seem to be created to prevent any possibility of wrongdoing or criminal activity or whatever, which I'm not saying it's a bad thing, but to say that crypto in general is used for crime or Tornado, is used for crime when it's really a 20% number. I mean, is that to say that the US dollar isn't used in crime?
Yeah, right.
At the time? Should we ban the US dollar? That doesn't make any sense. But because they have levers that they can pull here and essentially ban a product that 80% of the time has a legitimate use case, yeah, that seems pretty bad. Now, I feel like a better approach they could have taken to this is to actually go to Tornado and say, all right, if you're going to continue to offer this service, one, articulate for us what the legitimate need is, which is really simple. Hey, some people don't want to expose their, financial history to the world because you're on a public ledger.
Exactly.
And then another, question to that is, okay, do you know who they are? Do you have a KYC, AML sort of process in place so that you can, if compelled to do so, provide information on who's doing what? And if Tornado said, no, we're not going to do that, okay, well, then yeah, we need to lock out all people that the U.S. government has the authority to protect, the U.S. consumer. That's a different approach. This seems like, now, again, I don't know the full story. Maybe that did happen, and Tornado said, F off, we're not doing that, which, okay, cool. But if that didn't happen and they just came out with this and said, okay, all Tornado people, anyone who's used that service is a criminal, and we're shutting it down and sanctioning or whatever, that's an overreach. That just seems too broad.
Yeah, and the fact that this happened the same week as all this merge news seems a little coincidental. It feels like they recognize what sort of reaction this would have, and so they timed it up so everyone would be at least split attention. That being said, I mean, like yesterday there was this press release that a few of these protocols, I think 5 at least, so Oasis Dex, DYDX, Ren, Aave, Uniswap, and Balancer updated their code so they would automatically ban the wallets that weren't interacted with Tornado Cash. So this was in a press release. It was claimed to be done in conjunction with TRM Labs, but so there's at least one instance where this has truly happened. So there was this guy, I even saw this on Twitter. There was this guy that was airdropping 0.1 ETH to all these white labeled high profile public accounts. So it turns out that there were over 600 ENS addresses that got that 0.1 ETH from Tornado Cash. It claims they were blocked by Aave. But Mike, you said you went to Uniswap to try to use a wallet that it once interacted with Tornado Cash, and it hadn't taken effect yet. Do you know if it would take effect on Aave? Like, would it give you that warning?
I didn't try Aave, but yeah, Uniswap didn't block the wallet. It allowed me to trade. So I'm not sure if it's the exit wallets that are being blacklisted, like. It's not clear who they're banning or how the ban actually works, but it would be pretty. I mean, you want to shut your competition down. I'll just send them some Tornado Cash. Are you serious? That's terrible. If that's real, once again, like these projects, if that's what they did. But they're reacting just like the government. Like it's a complete oversimplification or over, I don't know, too broadening of a solution, too broad a solution. It just doesn't make any sense. Like, why would you lock? You have no idea if the owner of those wallets actually participated. Like, what was their intent? Who are they?
Yeah. So if this guy claims that all those addresses receive the 0.1 ETH. When you're on Tornado, could you put in like recipient addresses for the tokens that are getting split up? Is that how that works? Or would you have to put in some amount of money on the one side and then boop on the other side is all this ETH that he's now sending to those addresses?
Well, you have to claim the assets. So you deposit, and then you're given this kind of key, like a crypto phrase or whatever the hell it is, some kind of hashing thing. But you then take that key, you can go back to Tornado Cash and say, now I want to withdraw my funds. Oh, and by the way, withdraw it to this address. And that's where he could have 600 times said, okay, withdraw it to, withdraw 0.1 ETH to this address, that address, that address. It would cost him a lot in gas, assuming he's on mainnet. I'm not sure where he was, but you basically tell Tornado where to send it. It could be anybody. What a weapon to have against your competitor if you just blacklist them on all of it.
And the protocol still works too, so anyone could do this against any other address at the time for the time being.
Yeah, it's terrible. And then the other thing, like GitHub, right, taking the source code down. Well, again, go back to the 80-20 thing. If 80% of the people have a legitimate use, and open source in this community, in this ecosystem, is critical to understanding how the contracts work, how the protocol operates. So if you don't have the source code, you can't verify what's happening. So to take it down is actually putting 80% of the users at risk that the code is changing out from underneath them and they have no idea.
Yeah, exactly. It's pretty bad. Probably a good example of why you would need one of those decentralized versions of a GitHub for that code if GitHub decides to take it down.
Yeah.
I don't know what would be the alternative if you can't verify the contracts. Like you're really exposed to that risk that like say that they had taken down the source code for Tornado, they put a pull request, so all the new money would be going to the treasury. And that now the treasury just owns tornado contracts. So you're just sending money to them.
Yeah.
I guess could have done it in the background. There's no way of knowing now. Although the website for Tornado Cash is down, so I guess can't interact with it there. You'd have to go through protocol to do that. But I mean, this is interesting because, this is like a precedent for going after open source code, not going after individuals, sanctioned companies, countries. It's like, this is how you go after open source code. Go after GitHub. Where's the perma web? I thought this was supposed to be a thing by now. Where's our code backups for all this stuff?
That's a great point because GitHub now owned by Microsoft. It's a U.S. company, so yeah, they can easily be compelled to shut things down. So, but the world uses GitHub, so it's not just but now basically the U.S. controls all source code of the world, and that's, remember our early days as a team sort of chatting on things we wanted to do, and one of them was a decentralized GitHub just because of this risk. This is exactly what we talked about. Like, do you really want one perspective, one viewpoint to control access to the code that everybody uses around the world? I don't think that's right. And just to be clear, though, I mean, again, if Tornado Cash, as a company, project, team, whatever they are, if they're turning a blind eye and just ignoring criminal activity, that's different, right? Because that's intent. They know they're doing wrong and they continue to do it. Okay, fine. Something should be done. But there's a way to do this and do it legitimately, and it has to do with just having a KYC AML process in place and only allowing those players into the ecosystem. And it's not that they want to track them, it's that if a criminal enters that ecosystem, then you should be able to lock them out, or at least know who's doing what, if it's necessary, right? Go through the proper procedures, international or otherwise. Like, it's not just U.S. law. There's other laws in other countries that, prevent criminal activity. Whatever those are, you got to know who's involved. So I think there's a way that this protocol could still serve a legitimate use case, but have some mechanisms in place that make it legit from a policy and sort of legal perspective. But at the same time, it just feels like this is, I agree with you, Mitch. It's kind of, why does the U.S. government all of a sudden have control over something that is open to the world? It's a dangerous situation.
What other mixers exist out there? So like, did people? Because I felt like there were some forks of Tornado Cash.
That's a good question. I don't know. I mean, Tornado pretty much dominated the space. I know of a few teams out there that have developed. They've written white papers about how to do mixers using oracles, but they don't want to pursue it because of this very thing. This is exactly what they were concerned about. Like, if they put that out, then it'll be shut down because there's this possibility that criminals can use it, and if there's an inkling of a possibility, then the government will just apply this broad stroke punishment to it, and it's debatable whether that's really warranted here.
You could, if you were really sophisticated, you could also, in addition to sending the claimed Tornado Cash ETH or whatever you get on the other side, you put in pull requests to open source protocols and sneak in a bit of mixer code, and that puts it in the government's crosshairs. It's like, oh, that's a mixer now.
Yeah.
So I don't know how they're exactly defining it. I mean, had you ever looked at the code to figure out how it worked behind the scenes? Like, is there like a standard architecture for, or like the functions that you have to call?
Well, it's actually a combination of on and off chain infrastructure. They're smart contracts. That's obviously all open source. They use, you know, Merkle hashing and Merkle proofs to essentially claim reward or claim the funds.
So they're doing that process in some
Yeah,
ways.
but they're also controlling, like, the key that gets generated to withdraw your funds is actually, it's I don't know if it's stored in their infrastructure, but it's managed by their infrastructure. So you would need to know, and I don't think that part's open source. So you would need to know how they're generating that in order for it to actually work on chain. You have to know like what's going into that key, otherwise it won't be verified on chain.
That makes sense.
Yeah, but I think it's something that you could reverse engineer, I'm sure, but I don't know of anyone that's trying to compete with Tornado. But it looks like now there might be.
Yeah.
But then they know they're entering or going down this path that eventually they're going to get killed. So, you know, what bold soul wants to do that, knowing that it might be a big waste of time and money? So, again, you'd have to go into it knowing that you need a legitimate layer to it. Somehow you have to be able to respond to these legal requests that you may in principle disagree with, but, you know, given the situation and what's given the potential of how that product can be used by criminals, yeah, you sort of have to think about, well, how do we prevent that? It has to be part of the design right up front. And, you know, if you're not willing to do that, then yeah, you're going to be in the same boat.
Yeah, people were comparing all of this to kind of the cypherpunk wars in the 90s and 80s. Someone had even mentioned that at one point, email as a protocol was attacked. I don't remember that. I mean, obviously, I wasn't around then to know if that was happening, but yeah, someone said this is a rough equivalent to sanctioning the email protocol in the early days of the internet, with the justification that email is often used to facilitate phishing attacks. One of the other, so there are two other notes. The other note that I made was, so in addition to GitHub, Circle had taken action. I was trying to figure out what had happened, but they said they froze $75,000 worth of Tornado Cash linked USDC. I guess that's the extent of it. $75,000 is just, I guess you don't use it. Like, what, is it not backed anymore? What does it mean when USDC freezes their token? Can you not transact with it? Do they have some sort of, they target the address? That I don't know how you do that.
No, I think they're just saying that, if I had to guess, I would say they removed 75,000 of funds backing USDC, which basically means they removed that much of the supply. But I don't know what that means. Like, whoever has the USDC, they have it. Like, I don't think it makes a difference. Plus, if 75K, when the whole thing has billions, come on. It's not even, it's a gesture. That's a gesture. That's what that is. It's just, okay, we're complying. Please don't come after us.
They put out some blog post the other day about it. I was taking a look at the article. It doesn't speak about what happens behind the scenes that enables them to do that. They just say freeze. So there is probably some sort of function that they have.
If they know the wallets involved, then yeah, they could just basically say those wallets. Although I don't know how they would do that on chain. They'd have to change the token contract to basically have a blacklist of addresses that can't interact with it. Unless they're talking about the Circle platform itself, in which case, yeah, they could easily, ban that. meaning those wallets can't, withdraw to USDC, at least through Circle. But I doubt the criminals would be doing that anyway. So again, I feel like it's just a moot point. But again, given that Circle is a U.S. entity, yeah, they have to comply, and I'm not criticizing them for it. That's what they have to do. I'm just saying that it's the amount involved that, well, it's trivial relative to the entire size of USDC. So,
the government was like, oh, Lazarus Group had stolen all this money from all these contracts, and then they funneled some of that money into their North Korea's nuclear program. Apparently, $50 million was taken in crypto and used to fund their Best Korea's weapons program. That seems more relevant than USDC having or freezing $75,000, right?
Yeah.
So, I don't actually know how you track the Lazarus Group. I guess the government must see their addresses and see where the flow of capital goes. I don't know if I've seen any particular articles talking about North Korea exploiting a particular contract or protocol. I guess it just happens behind the scenes.
Yeah, that's a good question. I mean, you just hear that something was hacked. Do they know for certain? I guess if they claim, claims it.
So North Korea Lazarus hackers were blamed for a $100 million Horizon Bridge exploit. That happened in June.
Okay.
That was the Harmony one. They were also behind the Ronin hack as well. So Lazarus has just been hacking all these bridges. Damn you, North Korea. Jesus. Wow. Making cross-chain transactions much harder for us. Because they don't like other networks.
As weird as this sounds, hackers do serve a role in crypto, and that is making it better. Right? When you have an exploit, it's true in any system, right? Any technical solution, when it's hacked or crashes, breaks, I mean, that's what makes it better, because you learn from it and you fail forward. So, yeah, they're expensive mistakes, but those holes will be patched, and it'll make it harder for the hacker the next time. So, I don't know. I feel like, yes, it's terrible what's going on, but they are serving a purpose, in the sense that they're going to make this thing much better in the end.
Yeah, I guess the one benefit, right? One of the clearest benefits of this happening is that if you think about regulation and security, the most optimistic angle would be the government cares about contracts getting exploited, right? They care about all of your user money, getting siphoned off to some foreign government that cares zero about you and is making the world a worse place. I don't know if that's necessarily a consumer protection, but that would be the most optimistic outlook on this, is that if you remove the chances for someone who actually exploits a contract to have something useful on the other side, you remove the incentive for exploits to happen. But to your point, the exploits serve a role of ensuring security overall of the protocol. So what's the balance between security and threat minimization? I'm not certain.
Yeah, that is the big question. How much do you want an overarching authority to help you? Which, we will all debate on what that threshold should be, but yeah, I mean, it's a fine line, right? I mean, bad people, they're assholes. Come on, you're exploiting people. You're taking advantage of a situation. If you really wanted to help the ecosystem, if that's what the intent was, then you would just approach the protocols and say, hey, I could exploit this, right? And then, earn a bounty for doing that or something. But just flat out exploiting it and taking advantage of people, that's a whole different situation. Like,
yeah. So say that Tornado's down, but you still want to exploit a contract. Where do you go in your heist? I guess you find another mixer that hasn't been taken down yet and hope that none of the protocols have banned those addresses. And so hypothetically, what you could do is if you had, I'm not saying anyone should do this, but you could have forked or downloaded the Tornado Cash code, right? Then you launch it on your own and you call your own contract functions as the mixer. And so you could effectively get around this whole concept of Tornado Cash going down. Well, actually, does Tornado Cash rely on locked liquidity to function? Or is it just some sort of fancy function call?
No, but the advantage of a mixer is
there's a lot of other people in there, right?
Yeah. If you're the only one who knows about it, it's just you. It's pretty obvious. You made a deposit and you made a withdrawal. Okay.
It's just a transfer with extra steps.
Yeah, the idea is to mix it with a bunch of other people so that when you make withdrawals, you're hidden in the noise.
Yeah. So you couldn't just spin up a mixer overnight.
No.
Unless if you had, what you could do is you could have a shitcoin that you put out and get a bunch of people to throw liquidity in there, and then you somehow use all those addresses and you lock that up inside of this mixer or something. And so you're simulating with a wash trade sort of thing, what this mixer would look like. Because it is good if there's less incentive for people to exploit contracts. That's good for bridges. It's really good for bridges, which is a weird unintended maybe benefit of this, is that finally people don't come after that and we get a better cross-chain ecosystem.
Mm-hmm. Yeah, like I said, I think as much negative press there is around hacking, if we tried to paint a silver lining to it, it would be that, they are, in essence, making things better. By exposing the exploit, you're patching holes. So, but again, these people are just assholes. Like, come on. There's no reason to actually carry out the exploit if the intent is to make it better. Just make it better.
I think the clear intent is, if you know the code and you can get away with it, take as much money as you can. I would appreciate if more people were just white-hatted and so went in there with the kind of beneficial outlook like that. And people have done that before.
Oh, yeah.
Maybe that becomes the more popular activity now. If you can't get away with an exploit, alert a protocol that there is a clear hole, and that you could feasibly do it, but you can't really get away with it. So maybe that's a good benefit of this. However, obviously privacy going away is a pretty big, pretty significant problem. There's no clear solution to that right now. So,
well, there is, and it has to do with losing custody, right? You can always go through a centralized exchange and come out the other side to a different wallet.
That's fair.
And that is what a lot of institutions do. And that's a legitimate way of doing it. But you lose custody, right? You're now relying on that centralized entity to move your funds. And I don't know about everyone else, but anytime I'm waiting for someone else to move my crypto funds, I get really nervous.
Yeah.
Including the bridges. The bridges, it's a high anxiety situation. When is the money going to show up? I don't know.
Yeah.
Anyway.
So maybe it falls on the centralized exchanges now to have better protections against that they're going to think, okay, we need to, protect ourselves against funds that come in from wallets that are just transferred here. So maybe that's enough speculation for right now. Maybe we can call it there.
Yeah.
Cool. Well, so we have a couple other listeners in the space right now. If you guys want to talk, say hi. Feel free to raise your hand. I can make you speakers, whatever. If not, happy Sunday. have a good weekend.
All right. Thanks for joining us, and yeah, see you next time.
Cool. All right. Later, everyone.